On February 3rd, 2026, U.S. Treasury markets sent a quiet signal that almost no one noticed. The Federal Reserve had not raised rates. There was no emergency meeting, no crisis headline. And yet, the 10-year U.S. Treasury yield edged higher, even as traders openly discussed the possibility of future rate cuts. At the same time, reports indicated that a future Fed leadership path could involve lower short-term rates combined with continued balance sheet runoff, meaning fewer long-term bonds quietly absorbed by the central bank. In practical terms, this meant something subtle but immediate. Mortgage rates did not fall, corporate borrowing stayed expensive, and the U.S. government prepared to refinance trillions of dollars at stubbornly high long-term costs. Markets reacted calmly. Stocks barely moved. The news cycle passed on. But underneath that calm surface, a strange contradiction appeared. Rates were supposed to be coming down. Yet the price of long-term money was rising. Nothing broke, nothing crashed, which is precisely why almost no one asked the most important question. Why did easing expectations make borrowing feel tighter, not looser? Most people assume interest rates work like a single switch. Up means tight, down means relief, but that assumption quietly stopped being true. This is not a story about whether the Federal Reserve cuts rates, and it is not a story about inflation suddenly returning. It is a story about where financial pressure has moved. Short-term rates, the ones discussed in press conferences, matter less than they used to. The real pressure point now lives further out in time, where governments borrow, where homes are financed, and where long-term investment decisions are made. In that part of the system, markets don't respond to promises, they respond to risk. Risk that inflation could reappear, risk that debt will keep growing, risk that political systems will struggle to adjust fast enough. So even when policymakers talk about easing, the market quietly asks a different question. Who is willing to hold the future, and at what price? This is why borrowing can stay expensive without a crisis, why mortgage rates resist falling, why fiscal stress grows without panic. The system is no longer waiting for a decision. It is repricing time itself, and once that shift begins, it rarely announces itself loudly. What we are witnessing can be given a name: the long-end constraint. That term matters because it describes a limit that does not appear in speeches or headlines, but shapes everything underneath them. For decades, economic policy focused on the present: stimulate now, stabilize now, respond now. But the long-end constraint operates somewhere else, in the future. It reflects a growing hesitation not about today's economy, but about committing capital 10, 20, or 30 years forward. When long-term rates rise independently of policy intent, they send a message: the future has become harder to trust. This isn't a moral judgment, it's a pricing decision. Debt is still available, capital still flows, but it demands more compensation to wait. A useful metaphor is this: the economy is still moving forward, but it is doing so with a quiet weight added to every long-term decision: building a house, expanding a factory, funding a pension, rolling over national debt. None of these stop. They simply cost more patience, more certainty, and more margin than before. The danger of the long-end constraint is not collapse, it is compression. Less room for error, less tolerance for ambition, less flexibility when shocks arrive. And because this pressure builds gradually, it often escapes political debate. There is no villain, no single vote, no dramatic failure, just a slow realization spreading through markets, institutions, and households alike. The future is no longer cheap, and when the future becomes expensive, societies do not panic. They hesitate. To understand why the long-end constraint exists, you have to look past decisions and into architecture, the quiet systems that move money without asking for permission. This pressure did not appear because someone chose it. It formed because several structures began leaning in the same direction. The first structure is debt gravity. Over the last decade, the United States has shifted from issuing debt occasionally to refinancing debt constantly. Trillions of dollars mature every year and must be rolled over. When rates were near zero, this process felt invisible. Debt could be extended cheaply, quietly, and with little political cost. That era is over. Each refinancing now happens at a higher long-term rate. Not dramatically higher, but persistently higher. The result is mechanical. Interest costs rise even if spending does not. Deficits widen not because of new programs, but because time itself has become more expensive. This matters because markets price trajectory, not intention. When investors see rising interest costs feeding back into borrowing needs, they demand compensation up front. That demand shows up at the long end of the curve. The second structure is inflation memory. Markets do not forget shocks quickly. Even when inflation falls, the experience lingers. Energy disruptions, supply chain fragmentation, labor shortages, and geopolitical friction have taught investors that price stability is no longer automatic. This doesn't require inflation to surge again. It only requires uncertainty to remain. Long-term rates embed that uncertainty as insurance. Investors ask, what if inflation returns? What if policy is constrained? What if shocks overlap? Each what if adds a few basis points. Over time, those points accumulate into a new baseline. The third structure is central bank distance. For years, the central bank absorbed large quantities of long-term bonds, quietly stabilizing that part of the market. This wasn't always framed as support. It was often justified as liquidity management or crisis response. But stepping back from that role changes the system. When the central bank retreats from the long end, private capital must step in. Private capital does not have policy goals. It has risk tolerance. And that tolerance is shaped by debt levels, inflation uncertainty, and political cohesion. This creates a paradox. The Federal Reserve can lower short-term rates to ease conditions, while long-term rates remain elevated because the backstop is thinner. The result feels confusing to households and businesses. Policy sounds easier, but financing does not. The fourth structure is capital selectivity. In a low-rate world, capital chases ideas. In a higher long-rate world, capital chases certainty. Large firms with strong balance sheets still borrow. Governments still fund themselves. But smaller, longer horizon projects struggle to clear the higher bar. Housing developments pause. Startups delay expansion. Infrastructure timelines stretch. Nothing collapses, but fewer things begin. This is how financial tightening now works, not through denial of credit, but through hesitation. The fifth structure is political constraint. Lowering long-term borrowing costs directly would require explicit coordination between fiscal authorities and monetary institutions. That coordination carries reputational risk. It raises questions about independence, inflation, and fairness. So instead of decisive intervention, the system defaults to drift. The U.S. Treasury continues issuing debt to fund existing obligations. Markets continue pricing that debt based on perceived risk. Policymakers discuss relief but avoid actions that could be interpreted as controlling long-term prices. This is not paralysis. It is institutional caution, and caution has consequences. Finally, there is global rebalancing. Foreign buyers still hold U.S. debt, but they no longer accumulate it automatically. Reserve diversification, domestic priorities, and geopolitical hedging all reduce passive demand. More issuance must be absorbed by price-sensitive buyers. That shifts bargaining power. When demand becomes conditional, price becomes the adjustment mechanism. Put together, These structures explain why the long end constraint feels so resistant to rhetoric. No single lever controls it. No announcement dissolves it. No election resolves it overnight. It is the result of debt scale, inflation memory, institutional distance, capital caution, and global fragmentation moving together. This is why the system can feel tight without crisis, why growth slows without recession, why opportunity narrows without a clear culprit. The structure does not scream, it presses. The long end constraint does not arrive as a shock. It advances the way pressure does, quietly, unevenly, and often unnoticed until behavior begins to change. At first, the system looks stable. Short-term interest rates stop rising, and in some cases begin to edge lower. Headlines talk about easing. Markets appear calm. There is no sense of emergency. Yet long-term borrowing costs remain stubbornly elevated. Mortgage rates barely respond. Corporate refinancing stays expensive. Government debt continues to roll over at higher interest levels than the past decade normalized. Nothing breaks. Life continues. But friction appears. Households hesitate. They delay purchases instead of canceling them. Businesses pause hiring plans rather than cutting jobs. Budgets stretch a little thinner each month, absorbing higher financing costs without triggering alarm. Cash becomes more valuable simply by existing. Yield feels safe again. For some investors, this environment looks almost healthy. But over time, that friction begins to shape decisions. Banks become more selective, not because regulations force them to, but because risk feels less forgiving. Bond investors start demanding more compensation, especially from borrowers without scale or certainty. Credit still flows, but it flows unevenly. Large institutions with strong balance sheets continue to borrow. Smaller firms find terms tightening, timelines shortening, and patience shrinking. This is not a credit freeze. It is a filter. Capital no longer chases ideas as freely. It chases resilience. It prefers businesses that can service debt quickly, projects that pay back sooner, and borrowers that already look safe. Commercial real estate feels this first. Refinancing becomes harder, not impossible, just slower and more expensive. Regional pressures begin to diverge. Places that depend on easy credit feel the drag earlier than those anchored by established capital. As months pass, the system adjusts again, this time psychologically. Households begin to assume that borrowing will remain costly longer than expected. Businesses internalize that financing conditions may not improve soon. Governments quietly revise projections, treating higher interest costs not as a temporary spike, but as a durable feature of the landscape. This is where the long-end constraint stops being a market phenomenon and becomes a behavioral one. Fewer housing projects begin, not because demand disappears, but because the math no longer works comfortably. Long-term investments are reviewed more cautiously. Entrepreneurs hesitate. Career moves feel riskier. People still act, but with narrower margins for error. Employment does not collapse. Consumption continues. Growth does not vanish, but it slows without drama, like a river meeting resistance rather than a dam. At this stage, the economy still looks functional. In fact, it can appear deceptively calm. That calm is adaptive. People adjust expectations downward. They accept slower progress as normal. Ambition becomes selective. Then the fiscal feedback begins to matter. As long-term rates remain elevated, government interest expenses rise automatically, not because of new spending decisions, but because old debt must be refinanced at new prices. Deficits widen quietly. More debt must be issued simply to service what already exists. Markets notice, not with panic, but with pricing. investors begin to ask for additional compensation to hold long-term debt. Not because default is likely, but because scale and persistence introduce uncertainty. Issuance increases, yields respond. The loop reinforces itself slowly and mechanically. The system remains solvent. Obligations are met. The government functions. But trade-offs sharpen. Fiscal debates become more constrained. Resources that might have funded future investment are absorbed by interest costs instead. This is not a crisis of confidence. It is a narrowing of options. At no point does the system demand immediate resolution. That is precisely why the pressure persists. Each step is survivable. Each adjustment feels rational. Each response buys time. Eventually, a new equilibrium forms. Long-term rates settle at a higher plateau. Growth stabilizes, but at a lower potential. Investment focuses on certainty rather than expansion. Innovation shifts toward efficiency instead of scale. Public ambition becomes more cautious, more defensive. This is not collapse, it is acceptance. Reversing this condition becomes difficult without something external forcing change. A powerful productivity surge could lift growth enough to absorb the burden. A credible and sustained fiscal adjustment could reduce future issuance anxiety. Or a severe downturn could reset inflation expectations decisively. Absent those forces, drift dominates. The long-end constraint becomes embedded not through policy declaration, but through lived experience. People learn to operate within it. Institutions adapt to it, markets price around it. And that is what makes this escalation so hard to interrupt. There is no single moment to point to. No dramatic failure, no obvious mistake, just a steady climb toward a system that works, but works with less forgiveness, less flexibility, and less tolerance for miscalculation. The danger is not that the economy falls. The danger is that it becomes quietly brittle, stable on the surface, constrained underneath, until the cost of the future is no longer debated, only assumed. For most people, the long-end constraint never appears as a policy problem. It appears as a feeling. For middle-class households, it shows up in the space between income and intention. Mortgage rates stay higher than expected, even when the news suggests relief is coming. Monthly payments absorb more room in the budget, not enough to force crisis, but enough to delay decisions. Renovations wait, moves are postponed, big plans are quietly resized. Job security changes shape as well. Layoffs are not widespread, but hiring slows. Promotions take longer. Switching careers feels riskier. People stay put, not because they are satisfied, but because the cost of uncertainty has increased. For retirees, the picture is mixed and uneasy. Higher yields offer income on savings, but volatility adds tension. Market swings feel sharper. Expenses tied to healthcare, housing, and insurance continue rising. The balance between preservation and participation becomes harder to manage. Many respond by spending less, not out of fear, but caution. For small business owners, the constraint feels immediate. Loans cost more. Credit lines tighten. Expansion plans get delayed or downsized. Hiring becomes a calculated risk rather than a growth signal. Owners spend more time managing cash flow and less time imagining what comes next. For many, retirement plans tied to selling the business become less certain as valuations soften. For younger workers, especially those under 30, the impact is subtle but lasting. Entry-level opportunities become more competitive. Contract work replaces permanent roles. Housing feels permanently out of reach. Saving begins later, and later matters more than it seems. Risk-taking, starting something new, moving cities, choosing unstable but meaningful work feels increasingly expensive. None of this happens all at once. There is no single moment of loss. But over time, the economy teaches people a lesson. Be careful with the future. And when enough people learn that lesson, opportunity narrows, not by force, but by habit. The most unsettling part of the long end constraint is not what it does, but how quietly it does it. There is no crash to point to, no single policy to blame, no dramatic failure that forces resolution. The rules simply change. The future becomes more expensive. Time becomes less forgiving. Mistakes carry heavier consequences. Systems built on momentum begin to favor stability instead. Societies accustomed to growth learn to manage constraint. And once that adaptation settles in, reversing it becomes far harder than preventing it. History suggests that periods like this do not end with clear conclusions. They drift, they persist, they wait for something external to interrupt them, a shock, a breakthrough, or a reckoning. Until then, the pressure remains embedded. Governments continue functioning, but with fewer choices. Markets remain orderly, but less generous. People keep living their lives, but with smaller margins. The danger is not that the system collapses. The danger is that it continues, functional, stable, and increasingly resistant to ambition. And by the time the cost of that resistance becomes obvious, it no longer feels new. It feels normal. This is how structural shifts work. They don't announce themselves. They teach behavior slowly until alternatives fade from memory. If you want to understand what's coming before it becomes visible, before it shows up in headlines, statistics, or ISIS language, you have to watch the quiet places. Not what breaks, but what hesitates. Not what fails, but what no longer begins. Because the future rarely disappears all at once. It usually becomes expensive first, and that price is already being set.